I think the winner is Rick Santelli.
It is.
Especially playing Price is Right rules.
I'm
So we're going to go to Rick first.
Price Right rules. Yeah, Price Right rules. I don't think it mattered. Listen, this number has so many interesting things, but I'll obviously jump on what always gets me excited. 6.9, the unemployment rate, that's the wider swath, went up. However, for a very good reason, because participation went up. And I can't think of a better thing to occur to bring more people into the workforce. And of course, the average hourly earnings year over year up 3.1. That was also solid. The rest of the report, nothing huge. Obviously, the unemployment rate ticked up as well, so U3 and U6. But as I said, welcoming more workers in at this point in the expansion is a wonderful thing.
Okay, let's get out to Jason. Mr. Furman, you were low.
You can't argue. You can't argue with a higher labor force participation rate, the higher employment rate that you saw in this, a little bit of firming of wage growth. I think the big question, though, is how much the economy as a whole is going to grow this year. We saw it slow for the last 2 years. The first quarter, it's looking set for something like 2% growth. You know, how much further can the labor market go without overall economic growth picking up? We'll see.
Okay, Michael, glass half full, glass half empty.
The glass is half full for the month and probably half empty for the year. I mean, I think another question is how long can you continue to add jobs at this pace? How many more workers can you bring in off the sidelines? At some point, you're gonna run out of workers. We've been expecting that for years. It hasn't happened. Labor supply constraints have not yet started to bind, and we're seeing higher wages pull people in, which is a wonderful, wonderful thing, and an argument to keep the economy running hot. How long that can continue, I think, is an important question.
That's the question I'll ask you, Jason. How long do you think the Fed wants to let the economy continue to run hot?
I think the Fed absolutely wants the economy to run hot. It's well below its stated forecast or target of 2% inflation, and you're nowhere near that. I mean, I think on this show before, we've talked about the idea that the primary tool the Fed has used is the Phillips curve for many years. And in many senses, the Phillips curve is dead for the time being.
Right.
And that's because I think there's more slack in the labor market than any of us really thought possible. So you can continue to grow jobs without having a big increase in inflation.
What's the trade this morning? You're looking at the Dow, which was off over 100 points earlier, come down now off this news.
Listen, I think from this is a positive for the market as a whole, just to the extent to which I think some of the growth concerns that you saw last week, not this week, will probably dissipate. By the same token, I think I'm not sure we're out of the woods with some of the other kind of more macro issues, whether it's Boeing or coronavirus or some of those other things which may depress economic growth in the first half of this year.
If you're Jay Powell looking at this news this morning,
you're thrilled. I think you are in a perfect spot. You're not likely to have to ease, which the market is now starting to price in the second half of the year. And if you're the Fed, you would love to take a year off, it seems to me.
The professor, Mr. Liesman, has remained surprisingly quiet.
I only speak when called upon. I don't interrupt. You know that. I don't. Look. I don't want to put cold water because it's a very strong report.
See, I knew something was going on over there. You were looking at that screen with those. Yeah, okay.
I just have a hard time believing that north of 200,000 is the run rate of job growth in the country.
Well, this goes
because of a lot of the reasons that were said here, which has to do with the availability of workers. Jason is right that. To some extent, at least, we've pulled in workers that we didn't think were available to be pulled in. I'm not seeing the wage gains that justify your comment, though. Still just 3.1%, and you could imagine that if wage gains were strong, they would be north of 4%. I'm going to put a couple caveats in this with the general idea that it has been, this is a strong report. You had very mild weather in the month. Mm-hmm. You had a huge bump in construction. There is a 12,000 decline in manufacturing. I do not know at this point if that's related to what happened with Boeing, but there could be worse to come.
Okay.
I'm just going to leaven the whole excitement. Say it's great. 200,000 is great. I still believe the right run rate or the trend run rate of payroll growth in the country is more 150 to 175, and that is still strong.
Right.
I just think, and there may have been some statistical noise in this thing that got us north of 200. I just don't think it's that strong, which comes to the bottom line, which is I don't think the Fed has very much to worry about. Powell looked at these wage numbers, 3%, and said, That's not hot. If you had a hot labor market, you would be up north of these numbers right here. So just leveling a little bit.
Look, I would argue the run rate is even. I would argue the run rate is even below 150, 175. And a big story in 2020 is going to be the economy returning to those longer-term sustainable rates. You're going to see GDP growth decelerate and look a lot more like the underlying potential growth rate of the economy, 2%. Why? Because the fiscal stimulus from the Trump administration's tax cuts and spending increases has petered out. You're going to see, I think, monthly payroll gains reduce to something closer to their longer-term sustainable run rate, and that I think is going to be the story to watch. It's going to be interesting to see how consistent that is with low price inflation and strengthening wage gains.
So everybody here seems to have a pessimistic take on what next month and the month after is going to be.
It's not pessimistic. It's really not. I think that's the wrong way to think about it. It's just saying, you know what, 200,000 is stronger than the underlying trend would suggest it is.
Except for the fact that
some degree slowing job growth.
Go ahead.
Some degree slowing job growth is a good sign for the economy. You get really fast job growth when you have a high unemployment rate that you need to bring down.
Oh, God.
A healthy labor market, in some ways, is a slower growth rate. I think the thing I would keep my eye on most, though, is wages. Productivity picked up this last year. You didn't see that productivity pickup translate into anything like a commensurate increase in wage growth, despite an even tighter labor market. That is puzzling. That also speaks to what consumer spending might be like in the year 2020. That wage growth has been key to consumer spending growth. It's been key to GDP.
Sorry, Jason. I also might just take issue with the idea that the president's tax cuts are petering out. The tax cuts were put in place for 5 years. You have full expensing of CapEx. You have more territorial treatment of foreign source profits. There's no reason why they have to peter out. I do think that we offset some of the impact of the tax cuts with the trade war last year, but to the extent to which that's gone, that should help.
Go ahead.
Yeah, so the incentive effects and the tax cuts are not going to peter out.
Hold on, guys.
Hey, Rick, I just want to engage a little bit on the outlook for the Fed here. I've been not surprised, but I guess it's been a big change in the outlook for rate cuts this year, in that the market, in the wake of the coronavirus scare, which is still around, had begun to price in cuts as soon as this summer. It's backed off a little bit, but do you think that, I will just tell you my take is I think that's aggressive relative to the Fed folks I've talked to. And it looks like even, Rick, there were 2 cuts built in this year.
Well, on the 30th and 31st, people like Jim Cramer that are experts in stocks were afraid to buy a dip. So the world looked way different Thursday and Friday than it has Monday, Tuesday, Wednesday, and Thursday in stocks. That's the way we ought to think about Fed fund futures. It's just a market. It goes up and it gives you higher percentages. It goes down, it gives you lower ones, and it's traded as speculatively as any other short rate market. And as for how the economy's going to go, I'm not, I guess, as smart economically as our panel. Can't wrap my arms around all these quantitative and qualified formulas that nobody can ever really pin down. I've heard we're going to do this, we're going to do that, we're going to have a slower pace for over a year now, from many that are on the panel today that were there a year ago. The reality is, I believe my lying eyes.
But we had a slower pace last year.
Right, we did, and we've bounced back. It just doesn't make any sense to me that all of you can understand. You're underestimating how many we're going to be pulling back in the market. Pessimism, here's pessimism. We have coronavirus. We have trade treaties that were really messy before they were completed. And through all this, we are much higher in the overnight rate than the last administration, and we continue to grow.
Guys, we got to wrap
pessimism
up.
always wins in the end.
Conversation. I apologize. It's a good one. I know we'll do more of it.